What's up, guys, and welcome back to the channel. I'm Ty, and this is Stock Muscle. I think we got a special situation on our hands, and what I mean by a special situation is a company that's falling in share price sharply for reasons that are not directly associated with the core business. So a company that I like a lot is Activision. And if you watch any of my other videos, you guys know that I like the big three gaming companies. That's EA, Activision, and Take-Two. Activision's ticker symbol is ATVI, and the company is falling in share price because the company is being accused of facilitating a frat boy culture inside of the company. I don't have all of the details yet. I read a couple of articles, but it's kind of inspecific as to exactly what's happening. But apparently, there's been some complaints about the inner workings of the company and this frat boy culture, and Activision's ignored those complaints. So it's an employee problem. It needs to be addressed. It's never a good thing when you have people who feel discriminated on or people that feel excluded and things like that. So Activision needs to address this problem. But as an investor, we need to be like chameleons and be able to recognize an opportunity that's able to be capitalized on. As I said earlier, the core business is still intact. The company grew revenue by $2 billion over the course of a year from 2019 to 2020, and this is still a very strong business. Warren Buffett said that, you need to be greedy when others are fearful, and this is that kind of opportunity. So I've been paying close attention to Activision as well as Alibaba, but let's focus on Activision. Really strong company, some of the strongest video game brands in the world. World of Warcraft, Candy Crush, Call of Duty, which is probably at this point, I think, the top-selling video game of franchise of all times. I'm not sure about that. I'll check the record, but I gotta imagine that it's gonna be between Grand Theft Auto and Call of Duty at this point. So huge gaming franchise, and they maintain pricing control with this brand. They can do an annual release. I believe at this point Call of Duty is doing an annual release. I'm not a big Call of Duty player. I'm a Street Fighter guy. I'm a Guilty Gear guy. Not a big Call of Duty guy, but nonetheless, they can pretty much do an annual release with this game and have these sales eclipse themselves on a year-over-year basis. That's how strong this franchise is. They just launched Call of Duty Mobile, so they've taken the game mobile, and it's a huge franchise that I don't believe is going to slow down anytime in the near future. I believe the future iterations are going to be better and more popular than the last iterations. That's Call of Duty, that's Activision. But let's take a dive into the company. We have to do our due diligence. What we want to know is, are the fundamentals of the company strong, and can we buy it for cheap, even with the price dropping as much as it has? So let's dive in, guys, and let's take a strong look at Activision. This is a company I love in a sector that I really love. I haven't bought the shares, but after seeing the price action today, I'm really going to be taking a strong look at it as the week progresses. I want the stock to fall further. Will we get an opportunity to do that? I don't know. These video game companies are really strong, and you really don't get much of an opportunity too often to buy them on the cheap. These opportunities really don't present themselves that often. Activision is selling at, I want to say, 2019 to 2020 prices at this point. We'll dive into it. Matter of fact, let's get into it now, guys. So first and foremost, guys, I am the kind of investor that favors companies that actually make money. That means I probably don't buy a lot of growth stocks, which is true. I don't like to really buy companies that are net income negative, that isn't turning a profit. That's true about me. And I do buy some growth. Like, for example, I have SoFi as a main holding in my portfolio, and SoFi is not a company that's profitable yet. On an EBITDA basis, they're getting there. I believe last quarter that they went EBITDA positive, but the company is nowhere near as profitable now as I think they will be in the future. But nonetheless, let's take a look at Activision's revenue and net income. So revenue and net income is very strong. Like I said in the intro to this video, the company grew revenue. Let's go 2019 and 2020. 2019 revenue was $6.4 billion. 2020 revenue came in at $8 billion, so almost a $2 billion climb in revenue. Now, of course, they're getting a COVID push. We were at home more. People were playing more video games, and that's understandable. But the company's been growing revenue pretty strongly since its public inception. This company's also acquiring new businesses, like they own King, which owns the Candy Crush franchise. We haven't really seen a new World of Warcraft video game. We've seen expansions, but we haven't seen a next-gen version of World of Warcraft, which I think could be on the horizon soon. I think the company's keeping that in their back pocket. But revenue growth has been strong, especially with COVID. So 6.4 billion to 8 billion in the last 2 years. And the company's not pricing. At this point, this isn't priced in my opinion. Net income has also grown. So let's do a wider window on net income. So let's look at 2016, which was under $1 billion, $966 million in net income, and that's grown to $2 billion. So the company's growing the top line, they're growing the bottom line, and that's what we want to see. Another thing that I really like about these companies is not only do they grow the top and bottom line, the profit margins, I think, are going to grow. I mentioned this in my Take Two video. What happens with video game companies now is they'll release a game, they'll release a video game, but in truth, it's not the full version. The video game's going to, of course, have DLC, which is downloadable content, and they're also going to have microtransactions. So video games are becoming more profitable. A $60 video game could end up costing the consumer anywhere from $60 to $120, depending on if they buy the DLC, if they buy the additional characters, if they're making those microtransactions. So I'm really a bull on the video game industry. I love the big three video game companies because of that reason. These companies are finding more ways to make money off their video games. So I think going forward, all three of the big three, EA, Activision, and Take Two, are going to be more profitable. I really strongly feel that way. But that's revenue, guys. Next, let's take a look at the company's balance sheet. Got to make sure the company's solvent. So assets over liabilities. And typically with assets versus liabilities, we want to see assets triple liabilities. So right now the company has $23 billion in assets and only $8 billion in liabilities. So we're talking about a strong balance sheet. Not much to see here, guys. So let's move on. This company is solvent. They can pay all of their bills, no problem. So let's move on. Let's look at the company's cash position. Cash is really an important factor with the video game publishers. Why? Because a lot of the times, to facilitate growth, these companies need to acquire to stop the next competitor from coming along and climbing up your back. You're going to want to have the ability to buy them out. And you've seen Activision do that with acquisitions like buying the King Digital company. They're able to buy their smaller competitors and bring in that revenue. Also, video games are capital intensive. They're a large undertaking. They take multiple years, and it costs you multiple $1 million to develop a AAA title, which are just a fancy way of saying the top tier video games. So these companies need to have cash on hand. This company is generating good cash. If we look on from what we have here, we look from 2018 on to 2021 on a quarterly basis. They're growing cash handsomely. Now you're gonna, of course, see some fluctuations. If you see a large fluctuation, that means the company probably made an acquisition. So for example, if you look at 2020, Q1 of 2020 ending in March, the company only had $48 million in cash generated at that point. I'm willing to bet that they made an acquisition at that point. So I'll take a look into that, but the company's cash positive. So let's see how the company is broken down, because I looked at the investors relations page. The company did give us a strong idea on how the company is divided. So at this point, it's 3 parts. You got the Activision portion, which controls the Call of Duty franchise, and revenue growth has grown 72% year over year with Call of Duty Black Ops, Cold War, and Warzone. So they're actually killing it. That's a title that I think going forward is going to continually be a strong title. Blizzard, World of Warcraft is still the growth driver in the Blizzard division, 70% increase. As I said earlier in the video, it may be time to refresh WoW. We may need a new World of Warcraft. We may need a completely new and refreshed video game. I don't think the company's made a new one because the old one is still profitable. As you can see, that revenue is still going up there. So I guess the company at this point is kind of milking it, if you will. They're trying to get all they can get from that property. King, Candy Crush. I personally didn't know people still played Candy Crush to this extent, but revenue's up 22% year over year, so that's still a very strong property for the company. So these are the three main divisions of Activision Blizzard. You got the Activision portion, the Blizzard portion, and the King Digital portion. So revenue growth is strong from each portion. I think the company looks good. Now, the question is, can we buy the company cheap? Typically, when we're looking at buying a company cheap, I like to keep it simple. There are several ways to evaluate the cheapness, if you will, of a company. I like to rely on the old PE ratio. Some people would say it's overly simple, but this is a channel that's largely geared toward Main Street or newer investors and teaching them how the right way to buy stocks, if you will. So the PE ratio is a basic metric, but I think it's still very reliable. So let's take a look. Current PE is 30.4. Now that, guys, may actually be as low as 28. FinViz is showing 28, but let's take Morningstar at face value. They have Activision Blizzard as a 3-star stock. They have the current PE at 30.4. Now, when we're using the PE ratio, we want to measure the company's PE against itself, and you also want to measure it against the index that it trades in. So when we're talking about measuring the company against itself, the PE ratio, let's look at the 5-year PE ratio. That's the 5-year average. The 5-year average PE is 53.5. So like I told you guys, you don't typically get a chance to buy these video game companies or publishers for cheap because people know that they have pricing control and that earnings are probably going to be going up for these companies because they're finding ways to make their properties more profitable. The market knows that. So the last time we were able to get the company at under a 30 PE would have been 2019. You could have bought the company for 28.1. And 2015, it looks like we could have got the company at 26.3. But nonetheless, if you bought the company now at a 30 PE, I wouldn't feel like you were drastically overpaying. Let's look at the index that it trades in. The current index that Activision trades in is trading at a 25.8 PE. So when you do the current PE versus the index, you are appearing to be overpaying a little bit. But once again, if you compare it against itself, you're dramatically underpaying. So it's up to you guys as investors to make the determination as to if this is good enough for you guys. For me, I'm strongly considering taking a position in this company because I'm aware of what the future prospects are, and I really love the video game industry. So there you have it. That's one of the main drivers that I use to value a stock. And once again, you don't typically get a chance to buy these companies at these valuations. So what I want to see going forward is I want to see what happens with the company. I want to see if this news continues to drag the company down and drag the PE ratio down any further, or if it's going to bounce off the RSI. The RSI is the relative strength index. Typically 30 to 40 on the RSI is considered oversold. You'll see traders jump in and buy at those levels, and it'll push the stock price back up. That could very well happen with Activision, but I'm not sure. So there you have it, guys. That's the case for Activision. I didn't go too in depth. This was a rather simple video because I think it's a rather simple investment. I'm a bull on the video game sector as a whole. I think video gaming is only going to grow in strength for reasons that I mentioned earlier, and I'll reiterate those. The video game publishers are being really smart about their properties and finding ways to further capitalize on those properties with things like microtransactions, charging you in-game, with things like DLC, where we release the game, 3 months later, we'll release a whole new story to the game that you'll pay us $20 to $30 for. That's huge, guys. That's absolutely huge. So those are the reasons that I like the video game sector, and that I think the companies are going to be more profitable going forward. Activision is one of the big three. You got EA, you got Take-Two, and you got Activision. Those are the big three video game publishers. What we're going to see going forward with these companies is acquisitions. They're going to continually buy their smaller competitors and bring in that revenue. That's going to be a growth driver. And the releasing of AAA titles, of course. Activision owns some of the biggest titles. We're going to see more Call of Duty franchises come out. They have the Spider-Man video games at this point, which are big sellers. And I'm just a complete bull on the company. The share price is falling. Once again, this has nothing to do with the core business. These are internal problems that the company needs to figure out. but the business is fine. The business is intact. Part of the report stated that some of the AAA titles may be on hold. The creative process has come to a bit of a halt, but even if the games are delayed by 2 to 3 weeks to a month or even 2 months, I don't think it's going to hurt the company long time. So what I'm looking for Activision is I want to know if the price per share is going to keep falling. I want to know if the PE ratio is going to keep getting lower. Like I said, the company is considered oversold. It's probably going to bounce off the RSI. But what I want to happen is I want another 5% down day. I want the stock to fall into that high 70s range, and I'll definitely be picking up shares. So that's my theory on Activision. That's my thesis on Activision. It's a very good company. It's been growing for years. I believe it's going to continue growing. They're going to continue to acquire competitors. They're going to continue to release those AAA titles. I'm a big bull on the stock, guys. Leave a comment. Hit the like button. If you want more content from me, be sure to subscribe and hit the bell so that when I release a new video, you're notified by YouTube. So that's what I got on Activision, guys. Hit me up in the comment section. Let me know what you think. Thanks for dropping in, guys.